we've got an event-packed presentation-based event for you today. But without further ado, I will call on the CEO of the Nigerian Stock Exchange, Mr. Oscar Onyema, to give his opening speech. A round of applause, please.
Good morning, distinguished ladies and gentlemen. Let me start by establishing some protocol. The representatives of the Securities and Exchange Commission, the Debt Management Office, PENCOM, NIACOM, AMCON, the CSCS, the CEOs of the broker-dealer firms here present, the PFAs, and our distinguished partners, investors, and customers. It gives me great pleasure to welcome you on behalf of the Council and Management of the Nigerian Stock Exchange to this forward-moving event. Your participation in this workshop on retail bond trading and fixed income market making goes to prove your desire and commitment in contributing your quota to the continued growth and development of our capital market. And we thank you all for this. We have consistently communicated our objective of broadening and deepening the Nigerian capital market, and the development of the retail bond market is clearly in line with this objective. It is interesting to note that the federal government bonds were the first securities that were traded on our exchange in 1961, and bonds continued to play a key role in our market for more than 2 decades until the federal government halted bonds issuance in 1987. Since the first reissuance of bonds in 2003, the DMO has raised trillions of naira for the financing of public projects, and the revival of the FGN bond market has spurred state governments to raise funds via bond issuance. The bond market capitalization of the stock exchange, which stood at 3.74 trillion naira or 24.63 billion US dollars in 2011, grew by 55.61% in 2012 to 5.82 trillion naira or 37.44 billion US dollars. This figure is likely to grow even further because of the nation's dire need for new and revamped infrastructure. I might also add that there's significant interest from the foreign investors and participants in our bond market. The IFC, which is the investment arm of the World Bank, just recently announced that they're going to be issuing their own bond tranche, the first foreign bond issuance on the stock exchange. While we see this as a remarkable milestone, we are well aware that the bond market largely remains a playing field for institutional investors and high net worth individuals with little retail participation. This, my distinguished ladies and gentlemen, presents a clear opportunity to broaden and deepen the capital market. Over the past few months, the NSE commenced the implementation of a coordinated approach to developing the retail bond market. This workshop will be one of various avenues to acquaint all stakeholders with the structure and processes of the retail bond market ahead of its official launch in a few days. 2 weeks ago, we announced the names of the selected fixed income market makers on the trading floor of the NSE as a major step towards making fixed income securities accessible to the investing public. The companies selected went through a very rigorous process and met the additional net capital requirement of 500 million naira. We also examined their compliance history and looked into their operational capabilities, technology, and processes. I would like to state that the retail bond market is not set up to compete with the OTC market, but rather complement the structure by opening up participation in the bond space to retail investors who otherwise would have been excluded, as well as institutional investors with a preference for a transparent trading pattern. On behalf of the Council and Management of the Nigerian Stock Exchange, I wish to express my sincere gratitude to all our capital market participants, regulators, operators, retail and institutional investors, professional bodies and organizations, and the media for your unflinching support over the last couple of years. Whilst investor confidence is slowly being rebuilt, we still have a long way to go and many challenges to overcome. It is our hope that you will give the implementation of the retail bond operation your continued support, and this same measure of commitment will lead us to all-round market improvement in 2013. I trust that all seated here will concur to the fact that the market is in for better times with the introduction of retail bond trading and fixed income market making. Let us communally give it all the support that it needs. I also want to thank my staff for all the work that has gone into making today a reality, especially the product manager for fixed income, Dipo Omotosho. I wish you all a successful workshop. Thank you.
Without further ado, I would like to call on Mr. Dipo Omotosho to give a presentation on the fixed income market making program overview. Thank you.
Good morning, ladies and gentlemen. The focus of my presentation is on the fixed income market making overview. And in the last few years, we've been talking about retail bonds trading. And I remember some times ago when the exchange wanted the OTC to come and trade on the exchange. And just like what the CEOs have said, now is to complement what OTC is doing, not to have any impact on the OTC. So the fixed income market making program, in the last few years we have seen that the interest, the awareness of the fixed income securities among the investing publics, both the retail and institutional investor, is increasing at a rate that everybody is asking. You can see that what the yield is doing in the market right now. So the fixed income securities are another source of asset class for retail investors. And we have seen that the retail investors are attracted to the certainty of a fixed income instrument, and that's because of the steady income streams of fixed income securities. At least you cannot lose your principal. You can only, even if there's a capital depreciation, your principal is there. You have also, this, if it's a fixed interest rate bond, you have your semi-annual coupons as well. For retail bond trading to develop, liquidity is a significant requirement. And in just like what my CEOs have said, in NSE's focus on product diversities to have 5 products in 5 years, creating a viable secondary market is an important step to ensuring this. And the program, fixed income market program, will enable the fixed income market makers to trade all the market participants to trade listed debt instruments issued by the federal government, state governments, and corporations. It's also enabled it to be traded on a transparent order book with firm orders. The fixed income market makers will provide a two-way quote, which is a firm quote, to the market through the exchange of automated trading services. The two-way quote is the bid and offer. The bid is the price and the size at which a fixed income market maker is willing to buy a particular bond, and the offer is also the price and the size at which the fixed income market is willing to sell the same bond. This will apply to all pre-qualified and determined NSE listed bonds. The objectives of this program is to open participation in the Nigerian bond to the retail and institutional investors. It offers a more transparent pattern for trading bonds. This program does not replace the OTC, but rather complement it. It's not going to have any impact, negative impact, but to complement it. It helps deepen the Nigerian bond market and also ensures that all categories of bonds are traded. Market participants. One of the market participants are the selected, the appointed broker-dealers, which are appointed by the NSE. They are obligated to make markets in NSE-listed bonds. They are also tasked with the duty to provide liquidity and also addressing dislocations, imbalances in the market. We have the broker-dealers as well, which are registered NSE members. They are approved to represent customers, retail and institutional investors in agency capacity. And they can trade proprietary positions for their firms. We have the DMO Gospel Stockbroker. He's also an NSE registered broker-dealer. He's selected by Debt Management Office, the DMO, to be the buyer and seller of last resort on the exchange. Also, the AMCON market maker, also is an NSE registered broker-dealer. They will be appointed by AMCON of Nigeria to be the liquidity provider of last resort on AMCON bonds. Though AMCON is in the process of appointing their market makers. Then you have the regulators as well. The regulators, NSE and SEC, will ensure that participants are involved in best market practices at all times. Benefits of this program: retail first liquidity. It will give access to market access to retail investors. Then liquidity also, now that there's liquidity, it will attract more market participants. Price discovery and transparency. Trading bonds on the exchange platform will enhance price discovery and also give transparency to pricing rather than subjective pricing. Deeper bond market. It will extend market making beyond FGM bonds to all other listed bonds on the NSE, and then improves the depth of liquidity in the Nigerian bond market. The obligations of the fixed income market makers. One, they're going to compete for customers' order flow by providing two-way quotes, and this helps in enhancing retail bond liquidity in the secondary market. They are to offer quotes at or better than the best bid or offer most times. At the 90% of the trading session, they are to offer quotes. Trading bonds on the exchange platform will enhance efficient price discovery and then maintaining continuous two-way quotes with a predefined spread. This will be taken by the next slides. We're going to see the predefined spreads. One of the obligations is also to meet anticipated needs of the market by maintaining inventory. This will facilitate trading in specific spots. And also in pre-opening and closing, there will be auctions, and this will enhance the price discovery process. The requirements for selecting fixed income market maker. They went through rigorous process. The process was in two phases, where we first calculated the net liquid capital, then later the moving. If you pass through that phase, then we're going to look at your compliance history, look at operational capability, and then look at your past performance as well. Then these are the requirements. The robust internal risk management framework. We are looking, because they are staking funds, they are going to have a proper and robust risk management tools in place. Inventory management. They are going to be taking inventory in order to meet the imbalances in the market. Then appropriate level of capital commitment. If you are a broker dealer, you need 70 million. If you now want to play the role of a fixed income market maker, you need additional 570 million. That means in total you have net liquid capital of 570 million. But if you are playing the role of a primary market and also the role of a fixed income market maker and also the broker dealer, then you need 1.07 billion naira as net liquid capital. And we've also required that the traders who have extensive knowledge of trading and also understanding of the security which they are making market on, which is bonds. Other benefits of market making: listed bonds, more activity on the bonds that are listed on the exchange, increased liquidity and attractiveness, price improvement, and more transparency. For institutional investors, you will see more liquidity in the marketplace, easy entry and exit, enhanced portfolio diversification and management. And for retail investors, more liquidity in the marketplace, easy entry and exit. I must say there has always been entry, but there's no window to get out. So if a retail investor comes and buy bond, you find that he's locked till the maturity of the bond. Now with the fixed income market making, it doesn't need to hold the bonds to maturity. Then also enhance portfolio diversification and management. Prior to 2008, if you ask any retail investors, if you ask them, do they have a balanced portfolio, they will say yes. But you find out the portfolio is all in one asset class for different sectors. But with the retail bonds trading, we will see portfolio diversification. Then for the stockbrokers, we have increased liquidity, greater market depth, also revenue generation as well. So with the process, we went through we selected out of the 14 applications that we received. NSE appointed makers for fixed income securities are Capital Bangkok, Cordros Capital Limited, ESS Don Lauren Merrifield, FSJ Securities Limited, Greenwich Trust Limited, and Investment One stockbroker, formerly GTB Securities. Thank you.
Thank you very much, Mr. Motosho. Before we take questions, I'm going to invite Mr. Abimbola Babalola. Our funding known to the market is Bablo, to come and give a presentation on. He's actually, Mr. Babalola, known to all, is actually the head of market surveillance and will be making his next presentation on the new market structure as it's been changed to accommodate the fixed income retail bonds. Thank you.
Good morning, ladies and gentlemen. My presentation is going to be on market structure for the fixed income market. In terms of outline, I'm going to be talking about the trading platform, the trading schedule, the proposed or the market structure that we're going to use for the fixed income security, queue priority and allotment, transaction charges. I know a lot of us will be interested in this. We're also going to talk about the pricing conventions that we're going to use. Then I'm going to conclude my presentation. Talking in terms of trading platform, the trading system that we use at the Nigerian Stock Exchange is called ATS. ATS stands for Automated Trading System. It is a screen-based trading solution that has three components, namely the trading workstation. This is a client end of the trading application where broker-dealers are allowed to enter trades on behalf of their client. The second component of the trading engine or the trading system is called the message handling system. This is a middleware software that ensures that there's an effective and efficient feedback within the computer trading system. Then lastly, on the ATS, we have what we call the trading engine. The trading engine, as we speak, is the custodian of the trading rules of the Nigerian Stock Exchange. That is a system that is responsible for allotment of trade. And as much as we talk about price discovery and the system being efficient, these tasks or responsibilities are actually being handled by the trading engine of the Nigerian Stock Exchange. Tightly coupled with this trading engine is another system that is in CSCS. We call that Equator. That is a system that is responsible for the clearing and settlement of transactions that are done on the floor of the Nigerian Stock Exchange. And as you see, there appears to be something here. The big brother, what we're actually saying here is whatever we're doing on the floor of the Nigerian Stock Exchange is going to be within rules and regulations that have been approved by the Securities and Exchange Commission, ensuring that whatever we're doing are within rules and no individual or set of individuals have right or opportunity to abuse or manipulate the market. Talking in terms of trading schedule, as we have it on equity today, we trade between the hours of 9:30 a.m. in the morning and we close the market by 2:30 p.m. What we have today is that this trading period is divided into three. We have the section that we call the pre-open, and that runs between 9:30 a.m. in the morning to 10:15 a.m. in the morning. During this period, market makers broker-dealers will be able to put in trades on behalf of their clients. They can also amend their trades if they feel that they don't have a best price. They can also cancel orders if they feel they don't need them again. But during this period, what the system is doing is to accumulate orders from various participants, and based on the algorithm is going to determine what the equilibrium price is. Then the market after 10:15 will move to what we call open stroke continuous state of the market. This is the state at which prices or trades are being allotted. And like I did mention, the message handling system will also ensure that there is a feedback to every participant in the market. So you will know who is your counterparty, the price at which transactions were done, and at this stage, people are still allowed to put in fresh orders or to amend the existing order if they have not been matched. By 2:30, the market will go to close. At this stage of the market, broker-dealers and market makers are allowed to do their printing, generate statistics, and also upload data from our system onto their own in-house systems for accounting purposes. Talking about in terms of market structure, the market structure we're using is actually an hybrid. And what we mean by that is the broker-dealer community will use what we call the order-driven system, while the market makers will use quotes, wherein they'll be able to put in their bid and ask spread. But based on our system and based on the algorithm that I'm going to explain, the market is now going to aggregate all these orders in the order book, and based on that, based on the algorithm that has been defined, it will start allotting. For a broker-dealer to buy or sell bonds on behalf of its clients, the broker-dealer will be expected to issue either a buy form if he's buying for his client, or to issue a sell form if he's selling on behalf of his client. But most importantly is that every broker-dealer is expected to supply 4 basic parameters. And number one of that is you're going to specify the volume of interest, the securities symbol, the price at which you're ready to do the transaction, and the account of the client. If you're buying, you use the buy form. If you're selling, you use the sell form. For the market makers, this is the quote form. For the quote form, all what the market makers need to specify is the buy price, which is what we call the bid price, and also the ask price, which is the selling price. Then you will put the volume of interest, and at the end of the day, whether you are buying or whether you are selling, you are expected to press enter twice. At that point, what the trading system will do is to accept your order and timestamp it, and also give you a feedback to say that order has been accepted by the trading engine and is going to use or participate in allotment. Now, talking about allotment or the queue priority, at the end of the day, whether you are using the buy form or whether you are using the quote form, everything goes into one order book. In terms of how will the system recognize or position your order or your quote, that is what we mean by queue priority. You will see that number one on the queue priority is price. Price is a determining factor. And for the people that are buying, the higher your price, the better your position. So meaning the man with the highest price will occupy position number one on the queue priority. On the sell side, we all know the man that is selling with the lowest price will occupy the number one position. And if you look at this screen, you will discover that Yobe is willing to buy at 97 naira and is willing to buy 5,000 units. Because Yobe's price is better, is higher than that of another stockbroker who wants to buy at 86.50, Yobe's order is occupying number one position. But on the sell side, like I said, the lower your position, the lower your price, the better your position. Based on this, you understand the system will arrange this. Another important criteria is the cross priority. For those of us that are familiar with the system, cross priority is just talking about a situation where the buyer and the seller are the same. The system has a way of determining that, and it also allows the broker-dealer or the individual involved to profit or benefit from the charges he's going to receive on both the buy side and on the sell side. Next to that is what we call special field terms. For the broker-dealer community, you actually have the right to qualify your order. And this is where all or none, or all or none comes in. If you qualify an order, it's likely to impact on your trade or on your order. And what do I mean by that? It's like I put in 10,000 units, and I said I'm buying 10,000 units of a particular instrument, but I said all or none. What I'm telling the system is that at the point of allotment, if you cannot give me everything, please don't touch my order. Meaning the system will keep my order if the market does not have up to 10,000 to give me, and will allow other people to continue to trade. And lastly, you understand, we have what we call time of entry. Time of entry is just saying, it is true, the two participants can put in their order at the same price, but the first person to key in his order will occupy a better position or higher position than the man that has just keyed in his own order. Transaction charges. This is what we have. For this purpose, I think what we did was to divide or separate the bonds into two. We have the federal government bonds, and we classify state, local government, or what we call municipal and corporate. We combine that. In terms of fee, for federal government bonds, SEC is not going to receive any fee either on the buy side or on the sell side. For NSE, we're going to receive 1 naira for every 1 million transaction done, both on the buy side and on the sell side. The same thing CSCS will do, receive 1 naira on the buy side and also on the sell side. And the stockbrokers too will charge 5 naira for their brokerage fee. And one advantage of fixed income is that there is not going to be VAT, no stamp duty, and on the coupon that you are going to receive semi-annually, you are not also going to pay, or nobody is going to deduct withholding tax. For state, local government, and corporate bonds, the rates are, quite different. You know, for NSE, we charge 5 naira for transaction both buy and sell. For CSCS, they will charge 10 naira, and for broker-dealer, they will charge 10 naira. Talking about pricing conventions, the first thing I want to talk about pricing convention is on price movement. As we speak today on the equity side, you will see a situation where some stocks can go up maximum of 5% or 10% in a day, depending on whether the bonds has a market maker or not. But for bonds, we're not going to have anything like that. No minimum price movement for bonds. And also, we should also take note something which I'm still going to explain. One of the pricing conventions with fixed income generally is that they trade as a percentage of the par value. They don't trade in absolute value. What am I saying here? If there's a federal government bonds that has a par value of 1,000, and having done all my analysis, I believe such bonds should be trading at 900 naira. If I'm specifying my price, I will not put in 900 naira. I'm just going to express that 900 naira as a percentage of the par value or the nominal value, which is 1,000. The price I'm going to specify when I'm filling in my form will be that I'm buying at 90%, and the system will automatically recognize that. In terms of minimum size, we're not going to impose minimum size because we're talking about a retail bond trading program. So there's no limit size. But as times evolve, we're going to collect statistics, we're going to analyze our data, and based on that, that will guide us as to, making recommendations. In terms of bid and offer spread, which is addressing what the market makers will be doing, what we try to do as much as possible is to segment the bonds into 3 categories. For categories, and what we use as a basis of this our segmentation is actually the maturity. So in terms of maturity, for securities that have less than 3 years maturity, the spread is the minimum spread. No, the maximum spread is actually 25 kobo. For bonds that have maturity between 3 years and 10 years, the spread is 35 kobo. And for bonds that have maturity above 10 years, the spread is 45 kobo. In terms of matching order, I think I've explained that the system has a defined algorithm that it uses in matching orders. Talking about settlement, also as opposed to equities that will do T+3, for bonds, we're going to do T+2. Trading basis, this is very, very important as far as bond is concerned because of the way and manner accrued interest is calculated. And in our market, you understand, accrued interest is, wanting to know, is an accounting convention. That is, if you're trading within coupon payment, you want to know which portion of the coupon actually belongs to the buyer and which portion of it belongs to the seller. For us to arrive at this, the convention we are adopting at the Nigerian Stock Exchange is what we call actual versus actual. That is actual over actual. That is what we're going to use for in computing our accrued interest. And also of interest to us is that, are we going to be trading clean? Or are we going to be trading dirty? In terms of convention too, what we are adopting at the Nigerian Stock Exchange is you trade clean and you settle dirty. In order for us to appreciate what I'm saying, I think I want us to go through this example so that I can explain everything that I'm talking about. Let's look at this bond. The nomenclature of the bond is 10.5% March 2014. What this is telling us is that the bond has a maturity, the bond is going to mature on March 2014, and the coupon on that bond is 10.5%. And we have the ISIN number. The coupon date is 18th of March and 18th of September. This automatically tells me that this is a semi-annual bond and pays coupon twice on the 18th of March and 18th of September. And the annual coupon rate is 10.5%. So we now have a scenario of a buyer, a willing buyer, who has done all this calculation and believes that the clean price of that particular bond at that particular day should be 98.50%. And now he needs to, what you need to do, let me go back so that I can. Here, what the broker needs to do is to put the volume of interest, and I'm assuming the volume of interest is 1 unit, and he will put what? The 98.5 price here. The broker doesn't have to trouble himself in calculating the accrued interest because the system is being configured to automatically calculate the accrued interest for you. But we felt you should understand how the system arrived at that calculation, and that is what I'm going to take us through here now. So talking in terms of actual, you will discover that the transaction date is on 7th of May 2012, meaning the seller must have accrued some number of days. And if you look at the difference between 18th of March 2012, which was the last time coupon was paid, up till 9th of May, when the transaction will settle. You know, I said the transaction settled T plus 2. If you calculate that, you have 52 days. Then if you look at between the last coupon payment and the next coupon payment, which is between 18th of March 2012 and 18th of September 2012, you will discover that we have 184 days. So if you express 52 over 184 and you multiply that by coupon of 10.5%, because it is semi-annual, you also have to divide that by 2, meaning that the accrued interest per unit of this bond on that particular day is actually 1.48. And like I said, we trade clean and we settle dirty. So the system will now have to add 1.48 plus 98.50 to arrive at the dirty price of 99.98, at which the transaction will settle. In conclusion, I would want to say that the market structure that we're proposing for fixed income will not only support an efficient and effective price discovery mechanism, but will provide a fair, transparent, and an efficient market. These will run under a strong regulatory environment that will guarantee market integrity and protect investors. Thank you very much.
Thank you, Mr. Babalola. But I'd like to invite Mr. Babalola as well as Mr. Dipo Motosho onto the stage to answer questions over the next 15 minutes.
Chairman of today's occasion, distinguished ladies and gentlemen, my name is Michael Cole. Mr. Chairman, I'm highly delighted that bonds is now coming back again, a very good track. You see, when you look into bonds in the past decades, it's nothing to write home about. People run away from bonds for obvious reasons. And how can I go and invest a colossal amount and you give me peanuts? So as a result of that, I'm very grateful that now there is going to be a regulation on the bonds. And I hope this bond will not be taught to bondage. Mr. Chairman, having said that, I want to answer that hope it will not be hijacked by the foreign investors. And lastly, the market makers. You see, last time, when there was a proposal of appointing market makers, later there was a lot of complaint that the market makers are short of funds to take off. Mr. Chairman, I want to answer, what is the NSE doing now? Doing to put them on the right track? Thank you, sir.
For that question, what are we doing to stop foreign investors from hijacking the market? As you know, the Nigerian economy generally is trying to be an open economy that allows investors to come in freely and to exit freely. And we fashioned our market in support of that policy because we believe that it is the right policy. Today, you have a lot of foreign investors already in the market that have followed certain trends. The JP Morgan Emerging Market Index, Nigeria was just included, brought in about $1.5 billion into the market. In March, Barclays is going to include Nigeria. We expect additional funds to come in. So I think it would be wrong for us to then tell those same people that they can't participate in the market. We're going to run a fair and open market that allows anybody that wants to participate in a fair and orderly manner to participate. And if the local investors step in to participate, nobody will stop them from doing that. And so the same thing goes for the foreign investors. The next question is, what is the NSE doing to make sure that market makers, both on equities and fixed income, are well capitalized and have enough liquidity to actually carry out their obligations? What we did was, in the selection process, we wanted to make sure that only firms that had a certain minimum amount of net capital participated. That means capital that is very liquid, either cash or treasuries or bond or equities, listed equities. If it is treasuries, you got a higher haircut than cash. Cash is zero. And if it is equities, a higher haircut than fixed income, depending on the risk of the asset you're holding. So if you have illiquid security, if you had illiquid assets, that was not included in calculating your net capital. We believe that given that, and securities lending, and we've been talking to the banking industry to see how much more liquidity can be made available to the market makers, that they would be very efficient and they would be able to carry out their obligations. Bear in mind that for equities, the market makers the market making we've rolled out, primary market makers, is not complete yet. So we're still going to be rolling out supplemental market makers to support the primary market makers in equities. Whereas in fixed income, you don't have baskets. So you have multiple market makers making markets in the same security. So the market structures are very different. They have been done that way to position us best for each asset class to provide adequate liquidity and debt in the marketplace. I hope that addresses the two questions. Thank you.
Good morning all. I'm Abiodun Olide from Vertiva Capital. I have 3 questions. First, more like a clarification. I would like to know if the bid offer spread is the same for FGN and non-FGN securities. Then 2, I'm wondering if the focus or the immediate objective is to pushing liquidity for subnational and the corporate bonds, if that's our immediate objective. I'm wondering why we have different transaction fee structures for FGN and non-FGN. I'm thinking that will make trades possibility more difficult for both the market makers, the investors, and whoever as a whole. Then lastly, I would more like a clarification too. Is there any form of fee advantage that a market maker, the selected FIMM, has over a just a regular broker dealer? Just curious. Thank you.
Thank you very much, Olumide. I think talking in terms of the bid offer spread. The question is why is that we have? Does it include the state? Yes, the answer is yes. Because like I said, what we did was to classify based on what we did was to look at the maturity and use that as a basis for the bid and offer spread. And that's what I said, for securities that have maturity less than 3 years, the spread is 25 kobo, which is like 25 basis points. For the ones with maturity between 3 years and 10 years, we said 35 basis points. And for the ones that have more than 10 years, we said it's 45 basis points. So it's going to be across board. Then
let me just add to it. That is why we said the minimum size varies from bond to bond. What is going to be happening in FGN bonds might be definitely the minimum size might be different in state and corporate. Apart from the spread is the same. And just like what Babu said initially, it's going to be reviewed when we gather statistics.
Now, talking in terms why the next question is, we want to know why the difference in transaction fee. No, I mean, this was what was approved. You understand? And like Deepo said, we're going to allow this to. We're going to start with this, allow it to run for some period, gather data, analyze those data. Then we're going to come up with another. If there is need for us to review, we'll review. You understand? If not, we'll still keep to this. Then you want to equally know whether there's a fee advantage for fixed income market makers. Don't forget, fixed income market makers are doing proprietary transaction, not agency. So in terms of fee, you understand, they are not charging themselves, because a market maker is actually doing inventory. But where he makes his own profit is the spread.
I want to clarify if the charges, NSE charges, CSCS charges, if there's any waiver for these market makers relative to just dealer brokers. Because I, as a non-market maker, I can as well say I want to hold the inventory. But I want to know, do I have a competitive disadvantage from day one? That's my question.
I would say there's no difference, but definitely by the time we start looking at the volumes of transactions done, there might be rebates for the fixed income market makers. But just like what Bablu said, the bid and offer spread is the margin where they can make their revenue.
I think if I'm correct, that what the motivation behind that question was probably to do with the temporary waiver that was given to the equity market makers. That's what's driving that. With regards to fixed market makers, that does not apply. The only difference clearly is the rebate, which is driven by the volumes. I hope that answers the question. Next question, please.
Yeah, my question is just a request. For some of us who very slow in assimilating things, particularly because we have so many things to think about. Can you please send this to us through mail so that we can sit down, read, digest, and understand why we're taking action? Thank you.
It will be on our website before close of business today, so you can download them directly from the PDF versions. And if you have any questions, please send them to us. We'll add those to the FAQ, which will also be on the website.
Kennedy, I think is the name. I represent Rainbow FM. I'd like to know why the transaction for bond is T+2. And I want to know or have the clarity of what you mean by trade clean and settle debt. Thank you.
Yes, thank you very much. You know, I think we've said this many times, that our trading platform is so flexible that we can do T+3, T+2, T+1, and even possibly, if possible, T+0. But because, you know, the fixed income market, there's an OTC market that is existing now, and that runs on T+2. So we just felt there's no need changing anything, just to keep to the existing transaction cycle. That was why at the Nigerian Stock Exchange, since we have a system that can support that, that was the reason why we just felt there's no need creating confusion in the fixed income securities market in Nigeria. So let's just adopt a uniform transaction cycle, and that was why we opted for T+2. Talking in terms of trading clean and settle dirty, you know, I'm sure a lot of us are used to what happens in equity. If I'm using equity terminology, it's just like I'm saying you trade cum div or you trade ex div. So this time around, because the coupons are paid semi-annually, if I'm assuming that the months are uniform, it then means that between the last coupon payment and the next coupon payment, there's about 90 days. But what happened if after 2 months, somebody decides to sell his bond? It then means that at that particular time, that individual must have qualified, must have earned 2 months of interest. And the last person who is buying now, the buyer, will be the one that will earn the last 1 month. But in order to compensate the buyer, the seller, for the accrued interest that he ought to have earned, the buyer at the point of the transaction will pay him, so that the next coupon, which covers 3 months, coming from the issuer, will go straight to the buyer. So what I'm saying in essence is this: the coupon payment will be paid in 6 months time, but I've been having the bond, because it's semi-annual. There is 6 months between today's coupon payment and the next coupon payment. And the example I gave, let me take it again. When you say trade clean and settle dirty, means I'm buying, the price I'm paying is just a product of the price times the volume that I'm buying. But because it is possible, because it's a secondary market transaction, Mr. Dipok is the seller, I am the buyer. Within the 6 months, the bond was with him for 4 months. Now I'm buying it from him. It means he is entitled to 4 months of accrued interest, while I will only be entitled to 2 months of accrued interest. But because you don't want to create problem in the system, at the date I'm buying from him, that he is selling, I will not only pay him the clean price of that bond, I will also add to him his accrued interest, so that at the end of the day, in 2 months time, when the coupon will be due, I will receive the 6 month coupon from the issuer of the coupon, and the 4 months that I paid to him, you understand, I will have been able to recoup that from the issuer.
Let me just make it simple. Clean price is without accrued interest. We know that the accrued interest is the interest that are going to be paid semi-annually. So clean price is without accrued interest. When they said settle debt, that means the accrued interest has been added.
I guess I don't need to point out which one of the two of them is the accountant. Next question, please.
Mr. Chairman, sir, Tunde Rukuli is my name, and my questions relates to liquidity. As we all know, one of the challenges we are having regarding retail bond trading is liquidity. We have been talking to our clients, and they are excited that we're starting retail bond, and what we notice is that getting the stocks has been very difficult. With the appointment of the government stockbroker and the market maker for the NSE, I believe we should be able to get some liquidity. So I want to know, what are the relationship or the impact of the government's market maker to provide liquidity to the market, not just to the market maker, but to the market as a whole? And two, will there be consideration for state market maker, maybe relating to specific state bonds or maybe corporate bonds?
There's a session after tea which talks about the role of the government stockbroker. It might be more ideal to take that question. We've taken it down, but we'll take that question during the answer question sessions afterward. But the second question, I'll have Mr. Digbo Motocho take.
Okay, you said consideration for state market makers. That's your question. One thing is, fine, in equities we have baskets for each of the primary market makers. For the fixed income, the NSE fixed income market makers, there's no basket of the listed bonds. We have three categories of listed bonds. We have the sovereign, the non-sovereign, and the corporate. What we have done is the NSE listed, NSE selected appointed market makers are going to trade all eligible listed bonds. And what I mean by eligible is that some are going to pass through eligibility criteria, and which I believe that just like what Babalola said, Olumide said, is going to be dealt with in the next slide. And one thing again is that for FGM bonds, right now there are benchmark bonds which are being traded OTC. So all FGM bonds are going, all benchmark FGM bonds are going to be traded as well. And for states and corporates, they're going to pass through some eligibility criteria. And one of the eligibility criteria is must be rated by SEC-approved rating agencies. And the minimum rating is B plus. The minimum rating credit rating is B plus. And we said must have an issue depth of 30 billion. Those are the criteria. So anyone that passes through this is going to. Then your question again is any of the states going to have a particular market maker? No. It's going to be traded by all the market makers.
Thank you very much. My name is Tabidin. Let me first commend the NSE management for putting this forward. Honestly, this is long overdue. To say that the retail bond market will not, will serve as a complement to the OTC market. I would say that it's really good to take over that market because this is a transparent market. This is what the market should be. What we see in this market is nothing but just to carry on. It's not the real market, so to say. And so, for us to get the best out of this market, we also need to strengthen those structures around the market, especially these market traders, because they need to build the volume. If I'm going to be doing bond trading, say for example, just as a dealer, I'm not going to be contented going on 5 on 10,000 or 100,000 naira worth of bonds. That won't even pay my dealer. So we are going to do volume. And if we are going to do volume, we will take care of the both retail and institutional because they will come on their own because it will be done transparently. That I give you those to you. Now, my second question, or my first question really, but that was a comment. My question is, if the system allows us to trade claim and settle debt, why is it not configured in such a way that when I'm trading, yes, I submit my order, claim, but immediately I punch, I should be able to see the debt implication of it?
Yes, you will see. It is in the bottom.
Immediately, not when you are settling me.
No, you will see it immediately. You will see.
Get it right, please. Yes. I want to see the debt implication of that my claim price.
You will see how dirty it is.
Immediately, not when it's settled.
No, you will see it.
Thank you very much.
When I was explaining how the market, the broker dealer is going to trade, I said whether you are buying or selling, you need to issue the buy or sell form. And if you follow these, here is an example where somebody a broker dealer wants to buy 1 unit of a security and he puts 86%. And automatically the system is telling you that because this bond is 1,000 per value, 86% of that is 860 naira. And because the accrued days to the buyer side is 99 days, based on the day the transaction is taking place, the accrued interest on that particular transaction is 10 naira 87 kobo. You're going to have this information even before you press enter twice. I hope that answers your question. Thank you very much.
Sorry, if you see, you're seeing 99 days there. That is from the last coupon payment date to the settlement date. And that is what accrued interest is going to pay based on. For that's a tenor. And then this is the accrued interest, and this is your dirty, with the nominal amount, this is your dirty price, which is all-in price. And then let me quickly say something about the volumes that you're talking. If you notice, we did not cap the maximum size that you can trade. The only thing we have said is the floor. So if you want to do volumes, the system will definitely allow you, and the program will allow you to do volumes.
Your Ladino is my name, Practicum Securities. Really, I just want to re-emphasize a particular issue that was raised earlier on, that borders on the different transaction charges relating to sovereign bonds and states and the corporate. With the little knowledge that one has on this bond trading, I believe as it were now, FGM bond is enjoying a reasonable patronage, either at the OTC level. But unfortunately, the states as well as the corporate bonds are not enjoying the same. So for us to I just believe that at this level, maybe we can still do something to arrest or to encourage the interest on this class of bonds. Why we introduce this differential pricing, we need an explanation for it. That is why this differential charges for sovereign and corporate and states and corporate bonds. One. Then two, I believe for interest to be really, to get attracted to states and corporate bonds, the reverse will have been the case. That is, if it is not trading on the same level, that is, the transaction charges are not on the same level, then it should be lower than FGM. Because I still believe for liquidity to get attracted to that very particular bond class, there should be certain things that will stimulate that interest, and there's not going to be any other thing other than the accompanying transaction charges. So we can take a second look at that and see whatever we can do before we go online.
We need to take a look at this. It's probably not one that we can give an answer to immediately. Clearly the structures are what they are right now, and we go live on the 1st of February, which is only a few days time. But certainly, as been indicated earlier on, a lot of data will be taken over the next 2 to 3 months. We will review the situation, as we already have agreed with some of the market makers, and as things change, the market will be informed.
This article, I trade for Camry Securities. Let me just start on the lighter note. This issue of trading clean and settling native. We have a lot of financial illiteracy in Nigeria. I don't want this to know where tomorrow either the CEO or Action President or CIS President will be called and you started your native deals. So maybe we should be trading clean and be settling neat. Thank you very much. Yeah, my question is, I want to know the relationship between this program you set and then the OTC market, because I'm aware volume rests in the OTC market. And to a certain extent, we are not seeing the real transparency we want in the OTC market. What is the relationship? And then I'm aware that there is this association of security dealers. And you know better than I do. So what is the relationship? Thank you very much.
Let me address the clean versus dirty. I think that given that we're really determined to start this program February 1st, we're going to go with this. But with the new system coming on board, we'll make sure that we convert it so that they're actually trading and settling dirty. If you prefer to be dirty. So we'll go with clean and dirty for now, and then when the new system comes, we'll do dirty and dirty. With regards to your question, between the relationship between what we're doing here and what the FMDA has in the OTC market and what NSE is doing, let me start by saying we're trying to develop a structure that is supposed to be complementary to what those two institutions are doing. You should also know that we're shareholders in the FMDQ platform and in NASD, so it's really complementary. Now with the FMDQ, what they're doing is an institutional market. What we notice is that retail participants are not really active in that market, and that gave us an opportunity to put in what we're trying to do here. Everybody understands that you have to move towards a transparent market. So even the OTC is moving towards the transparent market, and that's why they're doing FMDQ, which will allow them to have quotes that are displayed. With NASD is more of a platform that is looking at companies that are not listed and trying to provide a transparent market for the trading of shares of companies that are not listed. For example, we all know that MTN is trading. We know that CSCS is trading. But we don't really know what the price is because it's not transparent. So I think that is a niche that NSE is trying to fill. And then they're also looking at a number of other asset classes outside of equities. So there's really no overlap. There's complementary in the sense that if you have an institutional size deal that you do on the OTC, you can lay off your risk by coming to the retail market to get rid of some of those positions, or vice versa. If you're trying to accumulate positions, you can come into this market and do it. So arbitrage would allow you to actually have appropriate prices. So if anything, we're really introducing greater efficiency in the bond market.
Right from Vanguard newspaper. If I heard you correctly, you said there's no limit to the quantity that one can trade. Maybe you should expatiate on that, whether you need no maximum limit or you need no minimum limit. Then secondly, the fees that were quoted, I believe those fees means fees per 1 million value of transaction, right? Now, the second question is that how, if a retailer comes and buy something that is not up to 1 million, how is the fee or the fees that he or she will pay, how will it be generated? I think that's very important. Then secondly, being a journalist, we write for the general public. I observe that there are so many technicalities, technical words and jargons that two people are using. And I think that the NSE needs to find simplified versions of these words for the benefit of ordinary people who are not brokers, who are not dealers, who want to participate in this market. Thank you.
No limit in size. What we have done is to put a floor. We did not cap any limit. That's just what we have done. The floor. It's 10 units. The floor is 10 units. The minimum size available to trade bonds to bond. I explained it when we were. The floor is just 10 units, which is a 10,000 naira if it's a FGM bond. For corporate, some of the units minimum subscriptions could be 100 units. So that's why I'm saying it varies bond to bond.
Thank you. In terms of the fee, actually what we have on the screen is fee per million. It's actually fee per million. For every 1 million worth of transaction, you're going to pay Nigerian Stock Exchange just ₦1. So, but in terms of a transaction that is not up to 1 million, you're still going to pay ₦1. So the minimum charge is actually ₦1. For every transaction that is not up to 1 million or equal to 1 million, you pay ₦1 for the exchange fee. Thank you.
I think with regards to that minimum fee, you would agree that if you think about the cost of processing a trade, I think 1 million is adequate. One hour rather. Thank you very much for all of those questions. We've taken all of those questions down. They will be on our website. We'll take a 50-minute break right now. Now, George from Dunlauren Merrifield to give us an overview of the role of the NSE's fixed income market maker. Mr. Shegun George, to the stage, please.
Good afternoon, ladies and gentlemen. My name is Shegun George. I represent a firm called Dunlauren Merrifield, and I'm here to give a brief presentation on the role of NSE market makers and introduction to the bond retail market. Just go through the outline. I'll be talking on the Nigerian bond market itself, what the retail market and the trading fixed income market making entails, how do investors participate in this market, and the benefit of trading on the exchange. Just to give an overview of the market, luckily the CEO of the NSE gave an interesting stat to begin with, and which I had no clue about, which is the fact that the first bond was actually traded on the exchange as far back as 1961. I mean, quite a few of us in this room probably weren't born at the time, but apologies if anybody was actually on the floor at that time and we haven't acknowledged you. Prior to 2002, the management of the country's debt position was undertaken by the Federal Ministry of Finance and the Central Bank of Nigeria. At the same time, the CBN acted as a main issuer of government debt, with issues mainly of expensive short-tenured securities in the form of treasury bills, which translated into high costs of refinancing, frequent rollovers, as open market securities were used to finance long-term government needs, effectively resulting in a mismatch. Just to explain a little bit further, what this would mean is that one-year instruments were issued and constantly had to be reissued to satisfy long-term financing needs, which was highly inefficient, expensive, and wasn't sustainable at the time. Following the restructuring of the debt markets, the DMO was established in the year 2000 to centrally coordinate the management of Nigeria's debt and the issuance of longer tenured bonds in 2003, which resuscitated the market as a result. They also acted as the issuing house and the registrar for all of these bonds and other instruments that were issued at the time, and recorded significant success and resulted in a paradigm shift towards the from short-term treasury bills to longer tenor instruments with maturities up to 20 years. Principally, maturing short-term treasury bills were refinanced into longer-term bills from 2 to 3 years. Then we had the 5-year, 7-year, 10-year, and eventually a 20-year issues. As a result of that, Nigeria today, as we stand, have a 20-year yield curve for our bond market. We also saw the emergence of, or the appointment of primary dealers on the OTC markets, which further developed the primary and secondary market for FGN bonds, and providing liquidity to underrun bonds across the curve. The Nigerian bond market witnessed significant growth over the years to emerge as one of the most liquid markets in sub-Saharan Africa today. This is excluding South Africa. Further illustration of where we've been, or where we began the journey from and where we are today. We can see that, excuse me, can see from the year 2000, with the establishment of the DMO, to where we were in the year 2003, we had a failed offer, or a number of failed offers at the time, of recallable bonds of 3-year, 5-year, 7-year, and 10-year bonds. In 2005, we had smaller issues of 2-year and 3 years. Regular monthly issuance of option-free bonds. In 2006, 15 primary dealers were appointed. We also saw further issues of the 5-year and 7-year bonds. In 2007, 5 additional primary dealers were appointed, and we saw the first reopening of an existing bond in this period. 2008, we saw the issuance of the 20-year bond. In 2009, we recorded the first market shutdown due to price volatility. I mean, this was an interesting time for most OTC traders, many of who are present in the room today and probably remember that time, where the market had to intervene and shut down just before it led to a meltdown. In 2010, we saw the release of new guidelines for the FGN bond market. And a year afterwards, we saw the issuance of the $500 million Euro bond for price discovery, which has a current yield of 3.65% as at the 11th of January this year. 2012 was an interesting year. We saw the addition of FGN bonds to the JP Morgan Emerging Market Index. This had a significant impact on our market, which I'll probably illustrate in a further slide further down this presentation. But just to illustrate how the significance of the bond market today and the size and the composition of how it's actually made up from 2001 to present day. We can see in 2002, the entire market size was about 5.1 trillion naira. In 2012, we moved up until 6.3 trillion naira. The compositions also changed slightly. Today, in today's market, FGN bonds dominate in terms of size of the market, followed by treasury bills and treasury bonds. Treasury bonds are an instrument highly liquid right now and redeemable by the Central Bank of Nigeria. So these are not, when we're talking about market making, we exclude these at the moment. Back then, we saw a 44% coverage of treasury bills. These were the shorter term instruments that we're talking about that weren't sustainable to sustain or to finance or fuel the long-term needs of our government. These are some further stats on the composition. Some of them I've run through already, but also I'd like to highlight that the total outstanding volume of non-sovereign bonds has increased from nil to around 617 billion naira over the past 6 years. These bonds are made up of 3-year, 5-year, and 7-year tenor bonds. Some further illustration on the composition of the bond market, where we still see the dominance of the FGN bonds in the market today. The states or the subnationals are catching up slowly. To date, I think we have 14 states that have issued state bonds. And a smaller chunk is taken up by the corporates. We're still looking for more participation in this segment of the market. Up here is a list of subnational bonds that have already been issued. The first column shows the issuer. You can see the issue size, the rating, the maturity, tenor to original tenor, and that tenor to maturity, or average life left on the issues. The coupons, the mid-price, and the yields. I have another slide that shows the corporate issuances already on the market. These are And some of the companies, a lot of them are household names that have been to the markets and raised debt instruments for various reasons. This is a very interesting slide because this basically shows how the volatility of the market is actually measured, and I'll highlight some certain areas. Where we see the blue stripes is where we actually have the MPC dates, and we can see as a result of those dates, you see a slight increase in market activity due to anticipation and anxiety, I could say. By August, where you see this green line there, that was the point of inclusion of the benchmark bond, the 16.39% FGN January 2022 bond. We saw a massive spike in the markets at that point, and a lot of it has been foreign interest as well. So we got much more participation after the inclusion of the Nigerian benchmark bond onto the JP Morgan index, which highlighted our country as one of the more interesting markets to invest in. I'd like to now entail on the retail bond trading session, trading and fixed income markets. This is an initiative that has been driven by the stock exchanges to make available bonds to trade in smaller units on the floor of the exchange itself. What it means to the market maker is you have to be prepared to buy and sell, or give quotes to buy and sell on a continuous basis throughout the market, the trading hours. In order to carry this out, 6 fixed income market makers were appointed. I think some of them, this has been mentioned earlier on, but I'll actually mention the names again. Capital Bancor, Cordros Capital, Don Laura Merrifield, yours truly, FSDH Securities, Greenwich Trust, and Investment One. The fixed income market maker is obliged to give quotes both on which he is willing to buy and sell if the counterparty should indicate interest at any time. You're probably wondering, the average investor out there is thinking, how do I get into this market? What do I need to do? Well, the first point is twofold. 2 simple steps is 1, you appoint a house as your fixed income broker dealer. And 2, you should have a CSCS account, or if you do not have one, the house you appoint will gladly open one for you. You'll have to discuss the appropriate and obtain appropriate advice from your broker dealer in which bonds to invest in. And once this investment has been agreed, a trade can then take place. It's a very simple process. You simply transfer your funds to required broker or custodian. Once the payment is confirmed in the custody account, the client's CSCS account will be credited with the bonds purchased. The same applies when you're selling your bonds at any given time. You call your broker, the investor notifies the trader of intention to sell. The trader sells, and the amount is then credited to your cash account. If the investor then chooses not to sell at any given time and wants to hold the bond for a lot longer or to maturity, he will simply enjoy the coupon payments that come biannually or semi-annually, as referred to in the bond market. And the interest will be paid on the face value, on the face value coupon of the bond as initiated. This is just a simple diagram that will show you those steps that I've just explained, from the appointment of your fixed income broker dealer all the way to settlement and confirmation from brokers on executed transactions. You'll probably be asking the question, what are the benefits of trading on the exchange? Well, they're simple. Some of them have been mentioned earlier on, fortunately enough, but some of the other ones we've highlighted are retail investors have direct access to the market. there's many as 6 fixed income market makers available to you at any given time, which you can call any one of them. Minimal transaction costs. Create further price discovery, as the exchange will create a transparent platform. Price level for each trading bond will be determined by the market, which is another important point. Retail investors can invest as low as 10,000 Naira face value, which was defined as 10 units on FGM bonds. But as I indicated earlier on, it will change from bond to bond. This 10,000 Naira is strictly for FGM bonds right now. And finally, I'd like to come to the risks associated with trading on the exchange. Well, the risk has been more or less mitigated fully because there's no default risk. There's no default risk at the moment because the exchange traded products and they settle directly with the CSCS. It's a straight-through processing automated system, and I don't think there's any risk of you parting with your money and we not delivering your bonds to CSCS. That concludes my presentation. I'd like to thank you for your audience this morning or this afternoon, and we look forward to you investing in the bond market. Thank you.
I would like to call on Mr. Shewan Benjamin of CSCS to give a presentation on behalf of Mr. Joseph McKellower, who is the head of operations. It will talk us through the clearance and settlement workflow for the retail bond.
Good afternoon, ladies and gentlemen. My name is Agbejimi Oluwasho, and I'm making this presentation on behalf of McKellower Joseph. And then the presentation is focused on the clearing and settlement workflow for retail bond market segment. The outline is categorized into 3 segments. Before I go further, there is no way you talk about clearing and settlement that you will not discuss the auction side of it, because currently most of the stockbroking firms, they don't have the bonds in their inventory account. So it makes it difficult for them to even trade on the floor of exchange. And then the question is, where is the bulk volume of the bonds had? And we all believe that the bonds are with the major dealers, primary dealers, market makers. So how do you get this bond from them? Via the secondary market. Then as well, if you had to participate in the primary auction, how do you go about it? We are going to look into that before we go into the clearing and settlement process. Auction settlement processes. We have 2 categories. We're going to consider the federal government bonds and the non-federal government bonds, which are the state and the corporate bonds. The need for this is for us to know what is happening in the auction part, and as well to see the function of major stakeholders, the DMO, the CBN, the brokers, we as an investor, individual or institutional, the settlement bank. So I will start with the FGM bond auction settlement process. DMO is the Debt Management Office, which are the issuer of the FGM bonds. Central Bank of Nigeria is a co-issuing agent, and as well the registrar, the settlement bank for federal government securities. The PDMM is the primary dealer market makers. They are appointed by DMO to participate in primary auction and as well to make market, etc. Investors it could be an individual or institutional. And the CSCS, as we all know, the clearinghouse in the Nigerian capital market. For FGM bond auction process, the first thing is that the DMO issued an offer circular a week before the auction day. I will use the T to represent auction day in my presentation. After that, once the circular is being released, Interested investors who want to participate in the auction execute an application form, which is available on the website of DMO and as well as the agent or any of the primary dealers. After the execution of the application form, investors submit their executed forms to any of the primary dealers of choice or any receiving agent. We stockbrokers, we are receiving agent. If you have customers who are interested in buying bonds, give them the form, let them execute the form, collate the document and forward to the licensed primary dealers. The role of the primary dealers here is to collate the application forms and forward same to CBN via the District 24 platform, latest by 12 noon on day T. I've defined day T as the auction day. Same day, latest by 4 p.m. on day T, the CBN will release the auction result. What happened next? Two things. After the release of the result on day T, if you are a successful beneficiary, you are expected to fund your account, your cash account with CBN on or before the morning hour of T+2. The T+2 is the settlement day when your account will be credited with the bonds at CSCS. Same time, as a primary dealer, if you have the result ready by 4 p.m. on day T, you are expected to forward the detailed list of the beneficial owners, the people that submitted their form through you to CSCS, so that CSCS will be able to transfer same bond to the final beneficial account. On T+2, the CBN, latest 10 a.m., after debiting the account of the primary dealers, will forward the auction result to CSCS to credit first the primary dealer's account. And recall that I mentioned that simultaneously, PDMMs too are expected to have advised the CSCS the details on the beneficial owners. And latest by 1 p.m. on the settlement date, CSCS would debit the account of the dealers and credit the accounts of beneficial owners. I would like to digress a bit. On the executed application form, there is a space box for your investor's account, CSCS investor account. Is the account number that you put there on the form that the primary dealers will capture in their instruction to CSCS for CSCS to credit. If you indicate an account number which is tied to a particular stockbroker, that is where the bond will be moved to. And as well, excuse me, if you quote the other side, there is a pool of account, we classify it as a bond one. This is where the CSCS will credit. So you have the option of stating the right account you want CSCS to credit your bond. Same day, after the transfer request has been executed, CSCS will revert back to CBN to update the register. So this is the auction settlement process for FGM bonds. For non-FGM bonds, I believe that we are familiar with this. It is the same flow as the equities market, but it's always good to remind ourselves the flow and move forward. Investors execute application form and submit to any of the authorized agents. The authorized agent also compile the executive forms and send to the leading house and the issuer. the leading issuing house does the allotment and forward details to SEC for approval. SEC approves and return the approval allocation to the leading house. Thereafter, the leading house forward the record of the allocated record to the registrar, who keep track of all the holders. And further, the registrar forward the approval allocation to CSCS via the online tool, in which most of us know as the data exchange electronically. And then CSCS credit the beneficiary account accordingly. And also update the register for update. So that's the primary set auction side. Now let's look at the secondary market, whereby there's an existing holder of a particular bond, and I'm a broker, and I need to sell. How do I talk to the primary dealer or a custodian who happen to be a bulk holder of a particular security, and also as an OTC participant? The first scenario, this applies to all stockbroking firms. The SBF that we have there represents stockbroking firm who trades on the floor of Nigerian Stock Exchange. The ATS is automated trading system. A particular stockbroking firm, in agreement with the primary dealer or a custodian, who are classified as a liquidity provider. After the agreement, they will do an in-house trade over the counter and transmit their trade instruction to CSCS online tool latest by 11 a.m. Getting to CSCS, CSCS matches and effect transfer, maximum 1 hour processing time. Let me digress again. If today I have an opportunity to sell the bond on the floor of an exchange, and I don't have the bond in my account, and I can talk to any primary dealer, and we all know that the NSE platform shut down by 2:30, you can quickly talk, and the security will be available in the individual account maintained with the stockbroking firm. For example, Agbejimi Oluwaseun, I have a primary dealer ABC, and I decided to detach my account. I prefer to use a broker CDE. First, as I mentioned, there must be Agbejimi Oluwaseun account maintained under CDE as a stockbroking firm. So when my bond is being detached with the assistance of the primary dealer, my account name will not change. There's not going to be a change of ownership. You still maintain the same name. So it's just like you are changing a broker. Maybe I decide not to use this broker, I'll use another broker. So what we are saying here is the name will not change at this point. Scenario 3 is peculiar to the fixed income market makers. And here, instead of talking to a primary dealer, we do an in-house trade, we do the transfer. A particular fixed income market maker can liaise with custodian or primary dealer as a liquidity provider, who will now give them access to the inventory account, be it their OTC account or a custodian account. After the agreement reached between the primary dealer or the custodian with the fixed income market maker, the primary dealer or the custodian advises CSCS to link the FIMM. The link in here works like this. Under the umbrella of the FIMM, I'm a liquidity provider A. under the FIMM, I will have a mirror account such that the market maker only buy or sell, but those inventory will not reside there. It will settle in my inventory account. So that's what the setting up at CSCS and creating a link account for the fixed income market maker represent. After the setting up, CSCS will notify the primary dealer or the custodian, who happen to be the liquidity provider, and the market maker of the details of account. So that's settled the scenario 3. The settlement process. For fixed income market, the market standard is T+2. And I know one day we'll get to T+0. On day T, trade participants are notified of their financial net obligations, including charges. Also, transaction charges are forwarded to the regulatory bodies. On day T, settlement banks too are notified of transactions consummated on day T, marked for your information only. On T+1, latest 9 a.m., the settlement bank notifies Nigerian Stock Exchange and the CSCS of stockbroking firms that may not settle trades of day T. Same on day T+1, latest 1 p.m. The final financial net positions of trade participants are forwarded to the respective settlement banks. On settlement day, T+2, latest 10 a.m., the final financial net position for each settlement bank forwarded to NIMS. Also, the settlement banks equally debit or credit our members same day. These are the abbreviations and their meanings. And finally, thank you.
Thank you very much, Mr. Negreji. Well, I guess if, like me, you've often wondered what CSCS does, yeah, there is. I would like to invite Mr. Shegun Sani of Stanbic IBTC Bank to give a presentation, an overview of security lending and how it ties into this entire process. Mr. Sani, round of applause, please.
Good afternoon, everybody. All protocols are duly observed. I want to thank you for the opportunity to speak to this August Assembly on the topic of securities lending in the bonds trading market. Definitely there's nothing new, absolutely nothing new that we'll be talking about in securities lending within this space. Is a topic or a discussion that we've had quite a number of times. I mean, I think even last time it was on the equity side of the business, and I think it's the only difference is just that the securities we're talking about here would be bonds. But I have about 7 slides, and I'll quickly do make a dive for it so we could be out of here in a short while. That's the outline of my presentation, to talk about define securities lending or explain it, and then talk about how we would use bonds to facilitate that process, and then talk about the transaction flows. Securities lending involves the transfer of assets from one party to the other. Definitely what it means is that a lender who doesn't have the view of selling his assets at a particular point in time may decide to lend it to someone who is willing, doesn't have the securities but is willing to sell them right away. It obviously is a means of infusing additional liquidity into the market, and I will talk about that when we get there. The transactions are facilitated by agents, and the agents can either act as direct agents or they can act as principal. What I mean is this: the intermediary will be acting as an agent where the lender has identified the borrower and has decided to lend to him and is only needing the services of an agent to facilitate that process. So all the risk involved in that is being borne by the lender. The other type is where the intermediary is acting as primary. I mean, a process where a lender gives the asset to the intermediary to say, well, I give you the responsibility to lend it out the way you deem fit, and then all the risk involved in the process of lending belongs to you. At the end of the transaction, what I want to see is that you put me back in the same economic position that I would have been if I didn't lend out my assets through you. So that's when you talk about acting as an agent or primary or principal intermediary between lender and borrower. And the borrower is obliged definitely to return the assets on demand or at the end of the tenor agreed for the transaction. So, of course, for each borrowing, there will be a collateral. And for any of these asset classes, the haircut that is agreed by the NSE and the market is stated against it. For equities, if you are using equities as a collateral, the haircut is 130%. For FGM bonds and treasury bills, 125%. And if you are using cash as collateral, that will be 120%. And the borrower is entitled to the economic benefits resulting from the assets. What I mean is this: if you borrow an asset, once you borrow it, every economic benefit that comes with it belongs to you, or you would, in the natural order of things, get the asset, the benefit, but you need to pass that benefit to the lender, because ultimately it belongs to the lender. So if, for instance, you borrowed the bonds and a coupon is paid to you, you need to pass the coupon on to the lender because it belongs to him. And that's what we call manufacture. Sometimes you might have sold down what you borrowed. In any case, I mean, in the normal order of things, you are expected to sell down, or you're actually borrowing to cover a short selling. Therefore, when a coupon is paid, because you have sold the asset, the coupon is no longer being paid to you. But because you have the obligation to make good the lender for every coupon that is paid, then you have to go into your own cash flow and, as it were, manufacture the coupon by issuing a check or a transfer to make him good for the coupon that has been paid. And the lender is not entitled to vote on securities that have been lent, but he has the right to recall. But that this issue around voting would only affect equities, not bonds, not fixed income securities. So the issue around voting, but if it were an equity security, definitely you talk about voting rights and all that. And when you lend out a share or a stock, you have lost the voting right for that period in time. But if you want to exercise your voting right, the only thing you can do is to recall the asset, the lending. The uses of bonds for SL purposes. As earlier mentioned, bonds can be used for lending and can also be borrowed in the market. One of the rules have been set, which is recognized all over the world, is that you cannot borrow a type of bond and use the same type of bond as collateral. Then the question will be, why borrow in the first place? And all bonds in the securities lending program will be marked to market by the agent. When an agent has lent out any security to a borrower and has collected collateral, he needs to mark to market the loan and it needs to mark to market the collateral on a daily basis to ensure that there is no mismatch in the collateral versus the agreed haircut, and also versus the value of the loan that has been executed. As it were currently, the daily closing prices for fixed income securities, you hardly see them on the exchange. It's not very transparent. It's something that actually happens amongst participants or on an OTC basis. But now that it's going to be on the exchange, definitely on a daily basis, the daily closing prices for these securities would have to be reported for everyone to be in the full picture when it comes to daily mark-to-market. So, I mean, this is just talking about the schematics. I think that about the end of the presentation. It's just talking about the schematics surrounding the various scenarios under which a lending transaction could take place. So, scenario one here is talking about cash being used as collateral. So the agreement between the market maker and the securities lending agent must be in place. And then for him to be able to borrow, he needs to first of all pay the cash, the collateral, and the haircut to the securities lending agent, who receives the payment and the haircut, and then logs onto the CSCS online to initiate the bond transfer, to initiate the lending, having collected the collateral. And then on the CSCS platform, the market maker also confirms to the CSCS that I'm expecting this transfer. And then CSCS receives the request via the online tool and validates, and then moves the asset to the account of the market maker, and then confirms, the market maker confirms the receipt of the bond. That is scenario one, simple as it is. Scenario two, when you're using collateral when you're using bond as the collateral, the same thing, agreement has been executed, then logs onto the CSCS tool to initiate a transfer of the bond, the collateral, to the account of the securities lending agent, and then confirms the transfer via the CSCS tool, and the CSCS receives the request and moves the asset, the loan, from the account of the securities lending agent to the account of the market maker, and the market maker confirms the receipt of the bonds. That is it. And then scenario three is one scenario that is a bit peculiar to Nigeria, where we're talking about the movement of collateral and the loan simultaneously, DBP, rather than for the collateral to go first. All over the world, I mean, it's usually the collateral that goes first, and then the loan takes place shortly afterwards. But in Nigeria, we have devised another end of trade as CSCS advice to settlement bank, instruction received from CSCS to credit. So at the end of the day, the proceeds of that sale would go to the lending agent to make up the 135%, whilst the credit of the security would go to the client of the market maker. So the CSCS will release the bond on hold to the market maker's position for the trade to consummate finally, and then confirms receipt. That is it in a nutshell.
Thank you, Mr. Sani. I would like to call on Mr. Dele Shotobo, the MD and CEO of Stanbic IBTC Stockbrokers.
Thank you very much. Once again, let me say good afternoon to everyone. And standing here today, I'm wearing two caps. Number one, representing my employer, that is the Debt Management Office, and also standing as a government stockbroker to, fixed income space. Quickly, what my job here is very, very simple, and is actually to throw more light into the role of government stockbrokers. As we are aware, late last year, DMO conducted an exercise whereby they invited interested brokerage firm to actually apply to act and to play that role. Over 17 houses that trades on the floor of the exchange do applied, and after a rigorous selection process, Stanbic IBTC Stockbrokers Limited emerged as the government stockbroker, and this appointment is actually to run for 2 years, after which it will be reviewed. I know a couple of issues have come up around why should it be one, but I will leave DMO to continue to deal with that. But strictly, who is a government stockbroker? And today we'll be looking at what exactly are the roles that we stand out to perform. A government stockbroker is that broker appointed by the federal government, specifically the Debt Management Office. And the primary assignment that we have is to be a liquidity provider on the floor of the exchange. It has been said over and over again that the bond market as we have it in Nigeria, before our own appointment, has largely been OTC driven. That is a market that is dominated and played only by the big boys, the banks and the discount houses, and but realizing that the agenda of the federal government is to democratize every process, even to the extent of investment, DMO thought it fit to say, okay, good, let us appoint a broker that trades on the floor on a daily basis and can actually be our face to provide liquidity for retail traders. As I've said, a government stockbroker is actually appointed to be a buyer and seller of last resort, which means at any point in time, you will see us in the market. And I am proud to say this, that since our appointment, for those that have actually cared to check, we've been providing quotes on FGM bonds on the Nigerian Stock Exchange on a daily basis. The quotes are there. We've had a couple of trades, and I know some of us, because we've been very used to the equity platform, but please, from tomorrow, go there, check, just change the REG to BND, and you will see the quotes provided by the government stockbrokers. Now, what are the benefits? We've mentioned a couple of it. The first one, as a result of our own appointment of, the appointment of Stanbic IBTC stockbrokers, is that retail investors can now access federal government bond on the NSE. Before now, the practice had been that we have retail investors that will go and participate in auction. They are forced to buy and hold to maturity, because there is no platform for them to actually sell the tiny amount or the tiny units they picked up during the auction. But as we have it today, you have someone that is stepping out on a daily basis to buy from you or to sell to you. The investing public actually gives them the opportunity to diversify their portfolio. Someone said it that before now, if you ask an average investor in Nigeria if he or she has a diversified portfolio, they will say yes, simply because there is Nigerian Breweries, First Bank, there is Dangote Cement, and the guy is just looking at different classes of equities. But The real diversification is for you to actually have different, instruments in your portfolio. So with the introduction of this, fixed income on the exchange, or reintroduction of it because they are usually been there, investors, they now have the opportunity to diversify their portfolio. Regular income is guaranteed once you invest in FGN bond, and it's an assured channel through which investors can sell their FGN bond. I've said that before. For the capital market introduction, actually, it introduced further stimulus for the bond segment, which means that you now see life coming into that segment of the income. High volume of bond transaction on the exchange. Before now, it has been zero, but we've seen it coming alive all over again. And for the economy, it's an improved savings culture by providing access to high quality investment for a wider segment of populace. Government has been in the market borrowing to, finance infrastructures. But between you and I, it has actually been for the high end of the market. But right now, because we are opening this up, individual retailers can actually give loans to government and be part of this government agenda. And it provides opportunity for retail investors to contribute to government development activities. Now, what are my roles? Well, what are the roles of government stockbrokers? During the primary offering, that is, the DMO issuing the FGN securities, it is our own responsibility to make sure that the information about the primary offering actually gets to brokers on the floor. And which simply means that if we pass the information to brokers as to the details of the FGN bond issuance, we equally expect that this information will be passed across to your respective customers. We ensure that the correct details of FGN securities, code, coupon, and all whatnot are stated correctly on the official list of the exchange. And the most important one, which affects every one of us, is provide bid and ask prices on the exchange daily. We serve as buyers and sellers of last resort. Now, quickly, let me throw more light on this, because we've had issues where broker-dealers community believes that with this appointment, their clientele base will actually be opened up to Stanbic or to any of the newly appointed market makers, But please, I stand here to say that is not correct. Your clients remain your clients. What we are saying is that just the way you deal equities for your client, the same way you are going to deal FGN bond or any other bond whatsoever for your client. It simply means that you step forward, you will see my quote, and I will trade with you without seeing the details of the client you are trading for. And also, when it comes to the primary issue, that is when DMO is issuing new bonds or reopening the existing ones, the simple thing, as Shehu said earlier, is that the application form is there on DMO website. When you download it, you give it to your clients to complete. There is no rule, I repeat, there is no rule that says you must return this form through Stanbic. No. I believe each brokerage firm, you do have settlement banks. And most of our settlement banks, if not all, are, primary dealer. Primary market maker in the primary side of the market. There is nothing that stops you from returning your client's application forms through your settlement bank. And it even makes life very easy for you because it gives them access to your account to debit if you are successful during the bids. So please, the idea that the appointment or my role as government stockbrokers will force you to expose your clientele base to me, it is not it is not correct at all. But if you choose to run it and put it together and send it through Stanbic, sorry, I'm open for business. We act as licensing between DMO, NSE, and other stockbrokers, which simply means that going forward, if there are any issues that any brokerage firm or any investor or any of your clients wants to clear with DMO, please route it through us. We would definitely get it across to DMO and provide adequate response. And part of our function is what we are doing here today. We participate with other market stakeholders to enlighten the public on this initiative. Now, process of trading, it has also been dealt with. Now, I have here minimum volume tradable is 100 units, which simply means that if I'm putting my quote in the market, you will see at least 100 on the buy side and 100 on the offer side with a price. That does not mean that is the minimum or the maximum. Sorry, that is the maximum I can do. If you hit that quote, definitely I am expected to replace it. Now, if the volume, because one thing that is very clear is that in this market, in the fixed income market, volume is a major determinant of the price at which trades will go through. That's why you will see that the price that you will see on the floor will be slightly higher than what operates in the OTC market, and that's a function of volume that both markets are actually pushing. But I will have this there. And CSCS account, one thing that CSCS have actually done is to ensure that the account that holds your shares, the equities, is the same account that holds your bond for any investor. So you trade both equities and bonds into the same account. If you don't have one, if you have an investor that wants to trade bonds and has never traded equities before, all that is required is for CSCS account to be open just like the way you open it for bonds, for equities. Clients are expected, and this is very, very important. Please note, when you are opening an account for fixed income transaction, one major requirement that must be supplied to CSCS is the bank account number. The simple reason for this is that when coupon is to be paid, when DMO or CBN will pay the coupon, there is no coupon warrant. You know, we have dividend warrants that they can post to you. There is no coupon warrant. What they will do is to credit your bank account. There are some investors in this, in the bond, in the fixed income space, that ever since they invested, they've never received anything, simply because the bank account details were not provided. So if you are using your existing CSCS account, you need to do an update, supply the bank account details of that client, and your coupon will be paid as at when due. We provide two-way quotes, and purchases and sales are executed on the ATS. Transparency, we cannot overflow that. This has equally been said. Dirty price and clean price will continue to trade like that until otherwise advised. And the trade settlement is the settlement cycle is T+2. Thank you very much.
Let's try and keep them short and as clear as possible, please. Can I take questions now, please? I've got one right at the back there. If you could give your name and who you're directing your question to, please. By
security lending speech man. And quickly, on collateral threshold, we're giving 130% for equity threshold, and considering the volatility in the equity market, the introduction of market making, some stocks are now 10%, they have 10% cap. And if we look at that, it's possible to have maybe within the first 3 days, the 30% extra can be wiped out. So what provision are we having for this so that we will be able to manage that risk? And at what point are we going to have the collateral call? That is, if it drops from 130%, maybe at 120% or 110%, when are we going to have the collateral call? And second one is to the CSCS guru. And you gave us the settlement date for the government bond, T+2. What is the settlement date for corporate and state bond? Considering the fact that we'll have the issuing houses that will be involved, and how will this be enforced to make sure that they work according to the timeline? Thank you.
I think I'll have the CSC's guru, as you call him, Mr. Agbejimi, answer that question first before Mr. Sani actually talks to the security lending question.
Thank you. To answer your question, sir, I believe that there is an offering timetable that details when your account will be credited at CSCS. And then that question again as a function of the registrar sending the details of the beneficiaries to CSCS. Thank you. Yeah.
I hope that answers your question.
Sorry. Is it the settlement? Is T+2 in terms of settlement?
Settlement after approval from SEC. When will it settle into the client's account?
I think you are mixing two things. When you're talking about approval, SEC approval, you are talking about primary issue. And that is as stated in the offer document, the timetable. There will be a timetable that guides that process. And until it is clear by SEC, registrar will do their bits, then TSCS will be advised and the account will be credited. But if you're talking about secondary market trading, it is still T+2.
Yeah, taking the question on the margin call and when we make the margin call, the process of collateral management is a daily process, sometimes even intraday. You need to do your collateral management on a daily basis, such that if, for instance, there's a 10% drop in prices, and instead of having 130%, you now have 120%, definitely you need to make a margin call that same day. And if it's not paid, you have the right to begin to trigger the default process for you to sell down the collateral so that you will not be in the water, by the next day. And you also have to remember the haircuts that have been agreed by the NSE are only the minimum. And therefore I have to look at the risk profile of the individual borrowers in fixing what I deem to be the appropriate haircut. So what I'm saying therefore is the haircut of 130% for Mr. A may not exactly be so for Mr. B. It's a contractual thing. So depending on the agreement between the lender and the borrower, they could mutually agree that instead of 130% for you, I'll do 140%. And if the borrower is happy with it, he provides 140%, and the deal is done. But the important thing we need to note is that the margin call, the collateral management process, must be done daily and must be done very actively with a very keen presence of mind. Therefore, if there's a shortfall, you don't wait till the next day or the next day until you are totally out before you begin to scramble to try to unwind your position. You need to do it that same day before it gets too bad.
My name is Dume Festus. I work for Financial Edge. My question is from Mr. Shin, CSCS. I listened carefully to your explanation, the milestones and delivery when the bond comes on stream. But my concern is that I'm afraid if CSCS is really prepared for this job, and again, if they will not really be perhaps a call to the wheel of this moving train, because experience in account opening for equity alone has shown a big challenge, and also intermember transfers to has shown a big challenge. So I don't know how CSCS is prepared to tackle these issues. Then lastly, in retrospect, I wanted to, I don't think Babalola will come up and address the issue of the trading schedule. When he was explaining the issue of the trading schedule, I was concerned that the timeline that they fix, that won't it cause a bit commotion between the brokers, dealer, and their clients when it comes to buy or sales order? Because I don't think there should be a need for initial testing work, bearing in mind that the NSE has the process of placing order for buy. I think if our lab will give a bit verification on that aspect. Thank you.
In terms of capability, I assure you that 100% in terms of technology, robust system, in terms of clearing and settlement, that CSCS system is efficient enough to handle the market making aspect segment. Thank you.
Sorry, I'm not sure I actually understood the second half of your question for Mr. Babalola.
Hello.
But I think what we'll do is we'll take a series of questions. We'll take a series of questions and we'll try and answer them as we go on.
The second question is on...
excuse me, can I just address the CSCS question? CSCS is already supporting bonds in the primary market and in the OTC. And they've been doing a fantastic job. In fact, they've been the only one doing it. So it shouldn't be a major stretch for them to support what we're trying to do here. And we've run through several scenarios. We've done mock trading, and they've been able to support everything that we're doing. So I just wanted to be sure that you all understand that we've done a lot of practice. So this is not theory that we're talking about.
My question is directed to the MBA or something that I'd like to know, as the buyer or seller of last resort for LGM bonds, supposing a client comes to you to buy a certain LGM bond and you don't have it and you can't source it from the market, how do you get it? Do you get to buy from the DMO out in the secondary market, or what's the plan in place? Thank you.
Thank you. My name is Ron Rao. I do work for Palesa Capital Market Industries. First, I want to make an appeal. And the appeal I want to make is that considering that the Nigerian Stock Exchange is a non-profit making organization, would it be out of place if standing stockbrokers in conjunction with DMO try to further educate the media as the role in the bond market? I think that will help us. Unfortunately, you heard the comments much earlier. I think it's something that you need to work, since you are the high between the public and DMO, I think it's something that you should take on as a way of also helping to deepen and help the market.
But having said that, I want to ask Mr. Sani if this is what he exactly meant to say. You talked about no recall when it comes to bond lending. If there is going to be a major change in the character of the bond, and the issuer is asking that will it be out of place for the bondholder who is lending on to ask for a recall? Because what I heard you say that there is no condition in which you have a recall. I want to be clear as to what your position is. But let me be honest with you. My major concern in all that we've been doing so far has to do with the role of corporate bond itself. Stanbic IBTC stockbrokers have been appointed government stockbroker because that mandate is active at the primary level. Can we say same for corporate bond in Nigeria? Because if all the emphasis is going to say raise money for government, government can sell and buy, what happens to the creative sector of our economy, which is the companies? So I don't know what exactly the exchange will be helping us to do. Because for me, one of the major concerns I think that quite a number of companies in Nigeria still do have has to do with the issue of cost, whether we want to run away from it or not. Yes, somebody is going to tell me the answer that in the US, the cost of raising some of these things is 505%. But what is the size that they are raising vis-a-vis what we are raising here? What is the size of our economy? What is the contribution of the corporate world towards the size of the economy? I think those are the major issues. And having said that, will it be out of place if we have the Nigerian Stock Exchange? Because one of the things that one of the presenters also did mention is that their business is basically to provide platform. And if you are going to provide platform, and the man who has to rock the streets in his canvas and jeans and t-shirts to bring the issue, will it be out of place if the Nigerian Stock Exchange will go back to the approving authority and say, sorry, for the non-federal government loan, we want to take our cost to 2 naira, for instance, on 1 million, and for CSCS to 1 naira, for instance, on 1 million. Because for me, the starting point should be getting more corporate bonds on our markets. If we don't have them, then we won't have transactions. Thank you.
Thank you for that. In the interest of time, please, can we keep those questions?
My name is Jerome from Transworld Investment. I want to know, during the primary offer, as a receiving agent, do I stand to gain the same 10 naira as commission, or I have special fee and who pays that fee?
Who is the question directed at?
Directed to
one more question, please. Can I
his name? My question is directed to Mr. Sani. I want you to educate me more on securities lending. For instance, if I lend you my security, and along the line, I discover that the prices of that security is on the rise, and I probably need the cash to do some other things. Will I be allowed to call for my security at that point in time?
I'll take one more question. Just a direct answer to that question. For those of you who've been following all that we've been doing over the last, 18 months or so, that information is actually.
I recall when I was running on speech, he said something like, I this is something now I'm a salesman. I'm going to have a problem with disclosing who my clients are. In the event where we have an issue with a client and we have to disclose DMO, is there any rule that forbids IBTC from having access to who my clients are?
I'll have the gentleman. That's a concern question. So I'll have the gentleman take the 5 or 6 questions that we have so far.
Let me take it from the rear. Number one, there's no rule that says or that prevents you from, revealing your client's details to IBTC or to anybody. But my own position is, if you are not comfortable to do it, nobody is forcing you to do it. But if you think you are open enough and you want to, of course, nobody stops you. So I think that answers your question. You are free to, and if you bring in your clients, what you are only saying is that, because the only point at which you can, through which you can bring your, reveal your clients, whatever, to me, is if you are submitting your client application forms, whatever, through me, right? And which ordinarily we do in our equities primary offering. Because when you put it together as a receiving agent, you submit to either the issuing house, as the case may be. So there is nothing hidden. But just to make my colleagues comfortable, is that if you don't want to route it through me, you can route it through your settlement bank, who I believe is equally a primary market maker in that space. Now, sources of bond, that is, if a client calling for a particular bond and I do not have it, I think in one of the presentation, part of what was said was that for you to actually play this role very, very well, you must have some of relationship with either a primary dealer or a custodian, right? And to even take it further, what clients are buying, unlike what we have in equities, where you want to buy Nigerian Breweries and it is Nigerian Breweries. You want to buy Guinness and it is Guinness. If you come to me today and you say you want to invest in federal government bond, what you are buying is the yield. So if what you are looking for will not give you, will give you a certain yield that you want to, and I don't have that particular bond, I can actually show you another one that will give you almost the same thing, if not the same thing, if not something better. So you have that choice. And that is where our role as brokers actually comes, the role we have to play. Understand what your client's intention or objectives are, what the tenor the guy is looking at, and what his investment objectives are, and you can advise adequately. So it's a case of, and if at the end of the day I could not, because we all know that there are some bonds that are not liquid, you understand? It's just for me to advise you appropriately, and to other investment windows or opportunities that you have. Investors education, yes, it's one of our role and it's one of our responsibility. And I think in the course of the year, between ourselves and the DMO, we'll actually be reaching out to the retail end of the market, the shareholders and their association, broker dealers community, as it affects their retail clients, so that we come together and they understand the benefit of investing in fixed income and what they stand to gain and what they will actually be protecting if they go into that space. Commission, I don't know the tenor you talked about, but in the primary issue, as we all know, even in the equity space, there is receiving agent, commission, which you get if you act as a receiving agent. So discuss with your PDMM, that you'll be routing your submission through, and something I believe can actually be worked out if there's any. Thank you very much.
Thank you, Mr. Shotsby. I'll have Mr. Sani come and answer a couple of questions that was posted his way.
I think there are just two questions. One as to if there be no recall of bond loans, I didn't say that there are no recalls. Of course, for any loan you can recall, and like I said in the presentation, that the cycle for a transaction, for any lending transaction, is on demand or at the agreed tenor. So you can recall the loan. What I was trying to explain in that space was that for equities, if there was going to be a meeting and you as the lender, you've lent out the asset and you wanted to vote, you wanted to exercise that voting right, you may decide to recall your loan so that you can have your shares to be able to vote at the meeting. That was what I said. But for bonds, since there are no meetings, like you have, I mean, in the case of equities, so the issue of a meeting or the having to vote may not necessarily be the reason, but you have the right to recall the loan at any point in time or at any time of your choosing. Secondly, if I lend my security and I want to sell, maybe I need the liquidity and I want to sell and I want to recall, can I recall? Definitely. It just related to the first question, you have the right of recall at any time of your choosing, because that is what is in the terms and conditions of the transaction. Thanks.
Thank you, Sani. I will take another 3 questions. Any questions out there? Can I have a question? There's a question here out to my right. Please, your name, the question, and who it is directed at, please. Rather important.
Yeah, thank you. My name is Tajuddin Olayinka. Honestly, I can see some interesting things, coming up, in this forum, and I think we should also do what is necessary to get it right. I will direct the number 1 question to Inishu Tubo. As the government stockbroker, you have access to the auction, the primary auction window. In other words, you take your client's bill there, you submit on their behalf, just the same with the PDMM currency do. I guess that was what you said, that you can take clients' request, their bids to the issue office for just for direct allotment through you. Was that what you said? Okay. Now, are you now saying that you don't have access to the auction window just like the PDMM? Sorry?
That's the question.
No, that's not the question. That's my question. There's a follow-up question on that. Now,
what's the second question, sir?
Okay, now let me say this, because if I believe you should have access to the auction window. If you don't, please have to go back, because you need that. I know that. Then, not only you, because you have to take this to DMO, and I think Stock Exchange should also work on this. To manage the volatility in that market, because you are bringing the retail investors to the market. I know that the institutional investors we also join them. But the truth is that the market makers that have been appointed, the 6 of them should also be given direct access on their own behalf to that auction window. If they don't have it, they should go back and get that rectified. They need to have that, so that what they bring to the market for secondary trading, particularly for market making, some of it can come from there to start with. Okay. So if they don't have that access, they should be given that access. Okay. Then the second question will go to Shegun George. You made mention of occasional shutdown in the OTC market because of volatility. And why I raised the issue of giving direct access to the auction window, that just for market makers only, was just because there is every need to manage this volatility. None of you have said that there is volatility in this market, but you mentioned it, and you said with the experience you had in the OTC market, it had to be shut down. So, if we are not prepared to manage that volatility so that we don't shut down here, then you create an additional problem, because what we are trading here is yield, and this yield is directly linked to what is happening in the economy. So, if the market makers cannot mirror the true yield, then we also have another problem. So, I want to address how you are able to manage that crisis then, and how we'll be able to manage that going forward, so that we don't create unnecessary volatility. Thank you.
So we can't hear you, sir.
Okay, my name is Eric Akinduro. I'm from the Ibadan Zone Shareholders Association. As I was just going through these papers that were inside the tracks that are inside the park, I was reading that particular portion there, credit or default risk. And I will need more clarification on this, because it was written there that in case there's a default from the issuer, that the person can access the risk of the bond by referring to the credit rating given by local and international credit rating agencies to the bond issuers. So I need more clarification on this, that how is it easy to access these local or international ratings, so that if there's a more clarification on this, we can know that the area of the risk in that aspect has been taken care of. And I think maybe it is Mr. Babalola or the man from IBTC could help us to.
So just to clarify, there's a question saying how do we access information from credit rating agencies? That's a question.
Yes.
Okay. I'll take 2 more questions in that sense.
Still goes to anybody. Taking into consideration what happened at the exchange in the recent past in terms of margin loan, did the DMO play any part in selecting the fixed income market makers, especially in terms of credit rating? That's one. And what's the relationship between primary dealer market makers and the fixed income market makers, in at least to effect proper execution of mandates and synergy? Again, what?
So can you raise your voice, sir?
My name is Benson Esamojumi. I write for Nigeria Communication Week. My concern is this.
Although we get a different mic to you, sir. Now they hear you.
My name is Benson Esamojumi. I write for Nigeria Communication Week. My concern is this. When we have a debt of equity in the market, the government will intercede to fix security. And now, stock exchange and every government agency is clamoring for fixed income security. The most attention, capital market is an elitist market. There is need for us, both the journalists and the operators, to educate the retail end of the market, because they are not going to take bonds to church like what happened in the equity market. And this issue of shareholder or no shareholder, and when it comes to accountability, you see some stockbroking firm will tell an individual fresh account owner to bring international passport or national ID card. How are you going to provide any alternative? Because you see Nigerians, very few Nigerians have international passport. And when it comes to accountability, except those who have the equity account before, how are we going to address this?
Everybody travels, and not everybody has a passport. I believe most people that we deal with drive cars and should have driving licenses. If they do not, then we have a problem. A driver's license is just good enough as ID for the brokers, I assume. So I suspect part of the educational, investor education that we talk about, clearly, obviously, the news agents and the newspapers are part of this process, and the exchange is always willing to engage with you, especially through the comms department. I will pass the questions over to the gentleman behind me to ask the question. Mr. Taylor, should go, please.
Access to auction. Number one, let me say this. For you, if I'm correct, for you to actually be licensed as a primary market maker by DMO and in conjunction probably with CBN, the minimum capital requirement is about 2 billion. I don't know if we have that capacity, right? But quickly, I will say that you, that is your firm and your clients, you do have access to that primary market. Let's not think that whenever there is auction, it's only for the big boys, it's only for the banks. No. As tiny as 10 units, your clients can bid. And if your client is successful, his account will be credited in CSCS. And that's why we're saying that we will provide information as regards various auctions. Market control will make the information available on the trading engine. Let us go out and tell our clients that are having funds unutilized, probably in their current account, in their savings account, that they can get something better as return by investing in FGN bonds or any other bond whatsoever. And we make the form available. They will complete it, and it's your responsibility to pass it and submit. Once they are successful, it's an asset, and it creates that volume, that liquidity that we are looking for in the secondary market. So the primary market is not closed to anybody. It's open to all Nigerians. I think I've answered the question, sir.
The question where the gentleman asked about the shutdown of the market. Well, first of all, at that period, it actually happened on the OTC market, and we hadn't migrated to the ATS machines, which we're using for fixed income market making, where we have price transparency, and the system operates on a continuous trading basis, so there's no chance of a shutdown. What actually happened back then on the OTC market is that you can't control the price because a lot of people on that market are actually trading blind at the time. The intervention of the FMDA and the DMO, we had a sit down at the time and resolve the issues around it, and the market went back to normal trading after that, went back to the two-way quoting system, and there were no further issues since that period.
Thank you very much, Mr. George. I would like to bring the the Q&A session to a close. Thank you very much for your attention. Before lunch, I would like to call on Mr. I believe all the questions have been answered. Can we do a round of applause for the gentleman, please? And thank you very much for your patience thus far. I would like to call on Mr. Arun Rajala Waziri, the Executive Director, Business Development, Nigerian Stock Exchange, to give a vote of thanks and a closing speech, please. Thank you.
Forgive me, my voice is somewhere it's not here, but I hope you can hear me. I'd like to thank everyone here who has found the time to go and listen to what we presented today. But before I go into thank yous, I want to say that I believe that you have spent 4 quality hours here to at least get a sense of what we're trying to do in the Nigerian Stock Exchange. And by the time you leave here, we expect that some of this information you have, you will go and share with your colleagues or with other stakeholders in the markets that you have access to. Secondly, I'd like to say that when we start trading in the fixed income section of the market, the quotes will be available in most of the market data providers, including Reuters, Bloomberg, hopefully next week, interactive data through FN, and then 6 Telecom, and the rest of them. So you're going to see the prices as an end of day, I believe, in the beginning, and then probably some of them will probably give live feed, but I'll confirm all of that information as soon as possible. I also want to say that the people we brought in here were, what I call partners in the market as well, and we'd like to thank them for taking the time out to sit with us, prepare these presentations, and also for their time and effort for being part of this particular session. I'd also like to thank my product team and the project team as well for a wonderful job they've done in ensuring that we met our targets in terms of the rollout for this particular product. Bablo and Co, Mr. Olumide Lala, Dipo, I want to show the rest of them, and especially Expo, who have had time to actually review all of the documents that will push it to them to ensure that we get to this particular point. Also, the SEC has been quite helpful. DMO, CBN, all of the other regulators, including FIMM, have actually participated in ensuring that we get to where we are here. Finally, I'd like to thank the people that have put together this particular event. Dante, Martins and his team. I think they did a quite excellent job, especially in trying to reach out to people to ensure that we have people sitting here to actually listen to what we're saying. So once again, thank you very much everyone, and lunch will be served to us. Thank you. Oh, one last thing, please, if you have any additional questions or you want to find out more information, our website is much completed with all of the information that we've given today, or will be by the end of the day today. And also, you can call us directly to find out more about what we're doing. Thank you very much.
All the stockbrokers that are members of the exchange can represent their clients on the automated trading system. What we did was to select market makers. Market makers, 6 market making firms were selected, and then 1 government stockbroker was selected for FGM bonds, whereas the 6 market makers can make markets across FGM, state and corporate bonds. Okay, now the way they were selected, well, why they were selected is to make sure that you have somebody that is there providing a two-way quote, a bid and an ask or offer regularly throughout the trading period. So they have obligations that they have to meet, whereas the regular brokers don't have any obligations other than to represent their clients to the best of their ability.
Like market makers for equities, we had an intermittent period. Are we having seen the same thing for fixed income?
No, with on the equity side, the structure is slightly different in the sense that we're going to be rolling out. So we're rolling out over a period of time, and you have 1 primary market maker to each security. Whereas here, you have multiple market makers to 1 security. So there's no basket, so there's no rollout period. You start trading, you're making markets in all of them. So the market structure is different, and so because of the nature of fixed income trading, there's no need for an experimental principle. So if it is FGM bond, it is backed by the full faith and might of the federal government of the country. If it is state bond, there are certain provisions that allow the coupon payments to come directly from their federal government account. Corporate bonds are a little bit more risky, and because they are more risky, the yields on them are higher to compensate for the risk. So the nature of fixed income is very different from equities, and that is why it's something, a good mix in your portfolio to have. Okay, thank you.
They have to go through stockbrokers. Will it be the same picture for investors looking to trade in fixed income? Do they have to go through the market makers for that?
Okay. Well, basically, yes. The answer is yes. The good thing is there's a flexibility associated with this. So in terms of flexibility, I mean, you can go to any one of the 6 appointed market makers who are also the retail brokers to execute your trades. Simply, the steps to take are, you approach or appoint your so-called broker dealer. They open an account for you. You deposit your funds. You specify which securities you actually want to partake in, and your trade will be executed on market. And luckily, 2 days later, it's a T+2 settlement process or cycle, and your securities end up straight into your CSCS account.
Okay, okay, we know the federal government has many listed bonds on the Nigerian Stock Exchange. How many are made available to the fixed income market makers?
Okay, basically all you need to do to actually have your securities traded on the exchange is actually list the so-called bonds. So if the federal government bonds are listed with the exchange, then they're tradable. Unlike in the OTC market where you have on-the-run bonds, so you have a whole list of government securities that are sitting out there but are not regularly traded. So at the moment we can see about 5 maturities trading on a regular basis, and those are the most liquid securities of government bonds available.
Okay, beyond federal government bonds, are we seeing fixed? Are the state government bonds, corporate bonds, are they also available to this fixed income market? Because, I mean, we know very well from last year up until now, the likes of state governments have not been very liquid. In your opinion, or what is made available to you at the moment, will state government bonds and corporate bonds also be made available to fixed income market makers?
Yes, there's been a great case to make these available for retail investors. However, they're somewhat peculiar compared to the federal government bonds. As fixed income market makers, a group of a consortium of us got together and actually decided what the criteria would be for eligibility to trade on this exchange. So basically, a couple of the things we actually looked at were one, what's the amount issued? So we're looking at nothing less than 30 billion. And the other thing was what kind of rating would be looking at to actually make these bonds eligible. However, there has been a lot of interest, and like we said, one of the initiatives of this fixed income market making was actually to encourage diversification of portfolios. So yes, we very much encouraged trading of corporates and sub-national bonds, state bonds.
All right. Last year we saw the appointment of several market makers for equities stocks. Now, a lot of people will say that that hasn't been as successful as they hoped, basically because securities lending hasn't been that available to them. Now, is that some sort of problem that you envisage for this particular program as well?
Okay, with the equities, we had a rollout plan of 6 months, which we haven't exhausted yet. But the stocks that are participating in this are doing quite well. The volumes have been on the increase, and also most of the houses are actually embarking on rolling out the entire baskets that they were allocated to trade. There are 10 market makers in the equity market, and I don't think they've rolled out up to 40% of the available stocks in their baskets yet. Some of them have actually been delisted from the exchange, which also has an impact, but they should be swapped with new issuances that have been released recently.
All right, and lastly for me, from late last year, we saw bonds prices rallying. I mean, it's been very significant. Do you think that the appointment of fixed income market makers would have some sort of influence on bond prices going forward in 2013?
Okay, surely would have, mostly because of the volumes that we're anticipating. If they do meet those anticipated volumes or the proposed volumes that we used for our projections, then yes, certainly will have a great impact on prices. But the good thing is it also creates price transparency, and there will be intraday auctions for price fixing. So I think all around is a healthy thing for the market.
Okay, sorry, I did say it was my last question, but I just want to chip in this. How excited are you as one of the appointed, your company Don Lorraine is one of the appointed market makers, how excited are you to be involved in this product?
Don Lorraine Murphy would always contribute to the encouragement of anything that will enhance our market in Nigeria as a country. We want to appeal to the foreign investor, and also just contribute as much as we can at any given point. We are very excited. We've gone all out to provide the infrastructure to accommodate this new activity in our market. Well, I'd say we're more than prepared to take on this one.
All right, thank you so much.
Thank you very much.